Hello, my name is Matt Russell. I'm an FX Power Course instructor here at FXCM. I want to welcome everybody to the Daily FX Walkthrough. Going to get started in just a moment. What I'm going to do tonight, as always, is walk through the latest technical report by Jamie Setley at DailyFX.com. So let's go ahead and pull up that report. And if you'll notice, it's the same report from yesterday. So I'm not going to go ahead and read the same thing that I read last night in terms of the euro dollar and the dollar yen. Nothing much has changed in that situation, and I'll get to that once I do bring up the charts, but I did want to speak about the Kiwi dollars. That is also a pair I've been focusing on in the report, so let me go ahead and read that. The implications from a short-term head and shoulder pattern are bearish as long as price is below 59, but there remains a possibility of a larger recovery in a C wave to above 61.37, same as the Aussie structure. Range traders may want to nibble at the long side here since Kiwi is at the lower end of its recent range. So let's go ahead and pull up the charts. The first chart is the euro dollar, and this is the triangle line that I've had for my previous, I believe, 6 or 7 reports. And we can see that prices have been contained beneath this resistance line. There were a few entries since I did apply this line, this entry here, but now prices, as I mentioned yesterday, looking at this chart objectively, you can argue that this is corrective action. So what I would look for moving forward is still to maintain that slight bearish bias against the upper resistance line of the triangle, but it does appear as prices are coiling an alternate count. Me just looking at this right now, this could be a B wave bottom right here, and this could be a 1-2, and we could, there is a potential that a third wave here, a third of a third, could explode above that resistance line. So this is something that I would keep in mind. If you are still short, I would still hold on to that short position, but keep in mind there is that alternate count which could mean a break above that resistance line. If that were to occur, let me zoom in a little closer here. We'd exit if we are still short on the first close above the resistance line. Let me get rid of this line, the lower line here, to make this a little more clear. We'd exit on a close above this resistance line and then see what happens on the breakout, and ideally we would look for an entry on the opposite side of this previous resistance line. Again, I'm assuming an upside breakout, and then look to enter on the long side. But again, we'd maintain that bearish bias until that occurs. We don't have to make any calls here. We don't have to be right. We just want to make money. So moving on to the dollar yen, that's the next chart, and this also is a resistance line that I've been using for the pair for my past, I would say, 8 or 9 reports, and we can see that prices are still contained beneath the resistance line. As I mentioned yesterday, the price action since yesterday's report only makes me a little more confident in the belief that prices will break above this resistance line as well. As I said last night, prices are coiling, it seems, just beneath the resistance line, and we can see that nothing has happened much since last night's report, and the prices are continuing to coil. So again, maintain that slight bearish bias against the resistance line, but be prepared for an upside breakout. Same logic would apply if there is a breakout. I can zoom in a little closer as well. We'd wait for that first close above the resistance line and then enter on the opposite side. But again, maintain that bearish bias until that occurs. The last chart is the Kiwi dollar, as that's what I did read in Jamie's report. As I was mentioning in yesterday's report, we might wait for a move down to that 54 figure, where a nice risk-reward entry could present itself in terms of being bullish against that 53.50 low. That's this low over here. And again, these are all 60-minute charts, so you at home, if the resolution isn't that good, just go ahead and pull up a 30-day 60-minute chart, because that is what I'm viewing, and you should see the same exact levels that I'm seeing. And again, the same argument could be made that this price action since the rally is corrective, so be on the lookout just in case prices do stage a rally from just, again, the issue here with the Kiwi dollar is that there's no clear line. We might draw a resistance line here, and I can go ahead and do that. I'll add that to the chart right now, and we might use that in terms of breaking out. But you can see the issue with using a resistance line here is that it's extremely steep. So even a breakout above this resistance line, in my mind, really doesn't hold that much significance. You know, it would be a bullish sign, but it's not very relevant, again, because the line is so steep that a chance of a breakout above the line has increased exponentially, and it doesn't mean anything in terms of the long-term picture. So the good risk-reward trade, again, would be down near that 54 level with a stop beneath that 53.50 low. Again, my name is Matt Russell. I'm an FX Power Course instructor here at FXCM. Thanks for listening.